We're back. Should you lean in even more to this record-setting market? That's surely a question our next guest is getting from his clients. Richard Saperstein is the founding principal and CIO of Treasury Partners and one of this country's top financial advisors. He is here, as you see at Post 9. What are you telling him? I asked you that question. What do you say?
Yes, we're in a CapEx super cycle. We've got $350 billion of tax cuts. The Fed is accommodative. It's adding to its balance sheet. The overall landscape for owning common stocks is absolutely tremendous right now.
Okay. That being said, you have been firm when I have asked you before about where to lean in this market. You have made the case repeatedly, including the last time we were together. Mega caps, and plays that are into the AI area, like Vistra, right?
Yep.
Which you've been in a long time. The market seems to be voting in the early part of this year that this is, at least for right now, in almost everything but tech rally. So how do you assess that?
So within the context of our portfolio, let's call it 20 stocks, 18 stocks. We have
pretty concentrated.
We are very concentrated. So in that context, we have banks, so financial intermediaries, and we added some drugs recently. Okay. But I think if you look at why we're overweight large cap tech, in the last 5 years, earnings are up 270%.
Oh, yeah.
All right. But the rest of the market is just 49%. Now, why would I try to tack away from that earnings growth where three hyperscalers have $550 billion in operating cash flow?
Okay.
I like the cash flow, Scott.
I know you do. And nobody can argue with you about the power of that earnings growth from the mega caps. It is now, and it will continue to outpace most of the other parts of the market.
Yeah.
However, the catch-up can be quite dramatic. What was a lackluster level of earnings growth from the 493, or parts of it, can be dramatic. And that's why those stocks can have such a big comeback as to why the market maybe has the makeup that it does. Does that make sense?
Yeah, there are names that one can look at for value. We've been looking at Procter & Gamble. You look out, that stock has come down quite a bit. Live Nation could benefit very well from a rising U.S. economy. Certain drug stocks. But for us, we want to follow where there's growth. We don't want to go into industries where they may recover or they may benefit from a strong economy. We want to stick with where that super cycle is right now, because that's what's worked.
What do I do with financials, for example? How do they fall in your perspective and something like that?
They benefit from a recovering economy, increased loan growth, deregulation, the whole story. Plus, we think the yield curve could steepen this year, where the Fed will cut rates, we'll get a little bit of a concern on inflation, you'll have the 10-year move a little bit higher, and that'll benefit the financials. We own JP Morgan, Bank of America, and Wells Fargo. You can also look at right here the intermediaries, KKR, APO, OWL.
Why don't you own Goldman Sachs?
We do own Goldman.
Oh, you own Goldman. You just forgot to mention that?
Yeah, forgot.
You forgot the best one of the year so far?
Yeah, we've owned that for a long time.
Yeah, I can pull it out of you. I'm a dentist
I should come in here with a list.
For real. I mean, what's the risk then? You laid out a bullish case at the very beginning. I just had this conversation with the professor and Jack of JPM and Steph, of course. And Steph said the Fed is the one risk that she would be worried about, that they don't ease enough. What do you think?
No, I don't think we need easing for the market to go higher. My concern is what happened this week, where we take out a leader of a country, then we tell the defense industry no dividends or return of capital, and we tell institutional investors you can't buy homes. I mean, that is interspersing with, American capitalism. And I think
so you're worried about that?
Well, that's a tail risk event. I think it'll self-correct if the market actually recognizes it and says, hey, we don't like that intrusion in the capital markets. But
who's going to say that?
Well, the market should really sell off on that news. Historically, that would be a bad thing for stocks. And so it didn't happen this week. There's a free pass. We'll see how it continues.
Well, I mean, it didn't happen really, because when you tell defense companies you can't do buybacks, but then
raise the budget.
An hour later, you want to raise the budget for the companies. Obviously, they're going to go more towards raise the budget than they are towards can't buy back stock.
Right. It's a good story. We'll taketh and then we'll giveth, right? But the fact is that the markets, the overall landscape for investing is very strong right now. And that's what the market's really signaling.
I want to ask you one more question about the idea of whether free market capitalism is being... we asked the question yesterday with Walt Isaacson whether free market capitalism as we knew it is dead because of those issues, telling companies what they can do. The chief executive of the country meddling in the business of corporate America and into the boardroom in a way that we're just not used to seeing. And how that might influence how CEOs might behave in the future, the kinds of decisions they would make, the amount of returned capital that companies may see, that you may see as an investor. I mean, are you thinking about changing the way you view this whole idea of investing in this narrative?
No, because we have a very pro-business administration. Think about the ease of permitting that'll impact oil companies, the deregulation, the more moderate touch of the FCC or regulatory concerns. So I think there's a lot of positives we have to look at, but clearly it's going to impact capitalism, stocks. It's not changing how we invest. Okay, but I think it's very important to understand that this administration is pro-business. The overall stock market will benefit from that.
Okay, we'll leave it there. Rich, thanks. We'll talk to you soon. That's Richard Saperstein.
Thank you.
Back here with us at Post 9. Up next, housing stock.